Hello students, this particular video is an attempt to make you understand that how the financial statements of sole proprietorship are being made. Right? So we will be starting with analyzing that what is the accounting process. In order to start with, we know that if a particular transaction is monetary in nature, only then it can be recorded in the books of accounts. So basically, the transaction has to be of monetary nature. That means it can be of the nature, it should be of the nature that it should be recorded in the books of accounts having a monetary value. Then comes recording. Only if it is in the monetary value, then it can be recorded in the books of accounts. The recording process is known in the technical jargon as a journal entry. After the transaction is recorded with the help of a journal entry, the next step is to classify similar nature journal entries, similar accounts into one such account, prepare each separate account which is known as a ledger accounts. So we take the closing balances of all the ledger accounts and prepare a statement for arithmetical accuracy which is known as trial balance. From the trial balance, the process of making the financial statement starts. Right? How do we actually make financial statements? Why are they required? Let's analyze this. So basically, let's assume in a particular organization, ABC Limited, you have invested a lot of funds, or you might be interested in investing a lot of funds of yours in this particular organization, ABC Limited. As an investor or as a potential investor or as a user of accounts, you would be interested in knowing that how the organization is performing. Is the organization making profit or is it incurring losses? Similarly, you will also be eager to analyze that what is the financial position of the organization with respect to the wealth, how much assets the organization is owning, and how are the obligations of the business organization that it owes to the parties. Right. So the assets which are owned by the organization would be termed as assets, and the obligations will be known as liabilities. These can be internal liabilities, which will be known as proprietors' funds, and these can also be external liabilities, which are further classified into long-term and short-term nature. Right. So now, starting with the statement to analyze the performance of the business enterprise. That particular statement, in order to judge that how the organization has performed during the year, would be known as statement of financial performance, which is nothing but trading and profit and loss account. Statement of financial performance, the name is nothing but trading and profit and loss account. As the name suggests, this is the account which tells us about the profitability, whether the organization has made a profit or incurred a loss in a particular accounting period. Right? Generally, that accounting period is of 1 year. On the other hand, we are also having another statement, which is statement of financial position, which is nothing but in the accounting technical jargon, it is known as balance sheet. And this balance sheet is having two components, two sides, I should say. One is from where you are getting the funds, as the name suggests, sources of funds. From where are you financing your funds? It can be through your proprietor itself, proprietor's funds, or the internal capital, or it can also be by taking long-term loans or by taking short-term loans, which are known as current liabilities. Right? And the other side of the balance sheet is known as application of funds. As the name suggests, how are you applying your funds? How are you utilizing your funds? In which assets are you investing your funds? Are these any fixed assets that you have purchased for the organization, or are you making any other investments? Or you are investing your funds into inventory or your debtors, which are known as current assets. If you're having problems in any of the components, you can reach out to me. I'll make a video on that as well. But since this particular video is on the financial statements, I'll not be going deeper into the various components like this. Right. Now let's analyze and see how the trading account and P&L account differs. Guys, we know that trading and P&L account in total tells us about the financial performance of the organization. But still, these are two different accounts. One is trading account, another is P&L account. What is the difference between trading and P&L account? Just analyze and just know that trading covers the direct expenses and direct incomes, whereas P&L covers the indirect incomes and indirect expenses. When we talk about direct, the actual meaning of direct is very closely related to each and every individual unit of an output. And indirect is which is not related, which is not synchronized with each and every single unit of an output. So if I talk about raw material, it is a direct expense. Why? Because for a particular t-shirt, you know that if one t-shirt requires 2 meters of cotton cloth, 2 t-shirts would be requiring 4 meters of cotton cloth. 3 t-shirts would be requiring 6 meters of cotton cloth. Each 2 meters of cotton cloth is individually individually synchronized with each and every unit of an output, which is one t-shirt over here, right? But if I talk about supervisor salary, no matter how many shirts are you manufacturing, you are paying the same amount to the supervisor, which is employed on a permanent basis and getting a salary on a per month basis. So supervisor expense, since it is not related to each, this cannot be related to each and every unit of an output. If you're manufacturing 5 t-shirts or manufacturing 10 t-shirts, it does not matter. He will be paid the same salary, therefore it will come under indirect expenses, right? So that is why supervisor kind of an expense will be falling under P&L, whereas raw material expense or direct labor, direct expenses, wages, all of those expenses, since they are each identified with each and every unit of an output, they will be following under trading account, right? So trading account, we are having two sides. It is also prepared in a T-shaped thing. It is having on the left hand side particulars and the amounts, and similarly on the right hand side also it has particulars and amounts, right? It starts with sales. So whatever sales, whatever revenues are you having will be written on the side, on this particular side, and whatever expenses you are having, for example opening stock, whatever will be consumed will be written here. So you are consuming opening stock, the stock which was left from the previous year. Whatever purchases have you done in this year will also be consumed by you. Since all of these are expenses, this is also an expenses side, therefore debit side is the left hand side. For every account, guys, debit side would be left hand side and credit side would be the right hand side. Okay, so opening stock, purchases, any other direct expenses. It can be wages, freights inwards, carriage inwards, and any other direct expenses. And whatever is not consumed, that will be my closing stock. Out of my purchases and opening stock, whatever I have consumed, I have written on the debit side. But since I have written the entire opening stock and purchases, I will be required to subtract that amount of stock which I have not consumed. That is why I am writing closing stock over here, because out of this total stock that has been written, that has already been booked as an expense, there is some amount of stock which is not yet consumed, which is known as closing stock. So I'll be writing closing stock over here. These are my expenses and these are my revenues, what I am getting. And opening stock plus purchases plus direct expenses plus wages minus closing stock is nothing but my expenses. So whatever would be left is nothing but my gross profit. So if your sales amount is greater than your consumption of expenses, you will be getting a balancing figure which would be gross profit. But if your expenses are greater than sales, you will be having a balancing figure here, over here, which will be known as gross loss, right? So this is how you will be preparing the trading account. Please forgive me for my for my handwriting here and how I'm drawing the trading account. Next comes P&L account. Profit and loss account, whatever gross profit has been calculated over there in the trading account will be carried forward over here, right? So if it is a gross profit, here I'll be taking in right hand side particulars, on the credit side, I'll be taking it over here by gross profit. Whatever gross profit was arrived in preparing the trading account, that is the one which will be taken over in the P&L account, because that is the profit level to start with. That is the direct, that is the profit that I've earned through my direct operations. Right, I'll be starting my P&L account with that profit and will be deducting the other indirect expenses. For example, salaries paid, supervisor salary, electricity, depreciation, all of the expenses which are indirectly related, rent, to each and every unit of an output will be written over here, right? Whatever, after deducting all the expenses, whatever I'll be getting is the net profit. If my gross profit is exceeding the expenses, the indirect expenses, I'll be getting net profit. Otherwise, I'll be getting net loss over here, right? And that net profit is belonging to whom? That is belonging to the proprietor. That is why this particular net profit gets added under reserves and surplus in the balance sheet, because reserves and surplus comes under proprietor's funds, and the business is having a liability, internal liability towards its proprietor. That is why within the proprietor's funds we will be adding these net profits which are not yet distributed in the reserves and surplus, right? The next comes the balance sheet. In the balance sheet, we'll be starting with the sources of funds, right? The sources of funds will be proprietors funds, and it will also be long-term funds. Okay, so you can call this as your internal liability, and this will be your external liability. And under application of funds, what are you having? You are having fixed assets and working capital. Working capital is nothing but current assets minus current liabilities, right? This is known as balance sheet. Since the name itself suggests balance sheet, it should always balance out. The total sources of funds should be equal to the total application of funds as per double entry bookkeeping, as per dual aspect of accounts. And if it is not matching, definitely you have made an error, right? So this video just tried to give an attempt in order to make you understand about the importance of financial statements of an organization. If you have any queries, you can reach out to me. My contact details are given below. You can read them. And if you want any other, if you want any other video to be prepared by me in order to have a clarity on a particular topic, you can definitely reach out to me. And as far as this particular video is concerned, this is referred with chapter number 18 of the book authored by T.S. Grewal for 11th standard, right? Thanks.